Shoot, what's your questions?
What is the best way to start investing or diversifying funds?
So, what I have learned over all my years is I want safe and secure. I don't like losing my money. Okay. Um, real or the stock market is honestly not good. Okay. Can you make money in the stock market? Yes, if you know how to trade, you day trade, that kind of stuff. You can also lose a shitload at the same time. I don't like playing that game. Um, and yeah, since I've been doing this since '93, I've ridden a lot of the waves of the real estate market. And yeah, the real estate market goes up and down. But the only time you start losing in the real estate market is when the market's down, you start selling. Why sell if you don't have to? So even in '08, which is the biggest crash we've had since the 30s, with that, I didn't lose any properties. The rentals I had all stayed rented. The values dropped,
Right.
but my monthly income still came in. The mortgage companies or private lenders still got their money. So it didn't matter if it was down. Now it's back up. I still own a lot of those same properties, and now they've climbed even higher. So I didn't lose anything, because you talk about equity and properties.
Right.
Equity and property is just a number. It's a fantasy number. It only comes into play when you sell it. So you either have negative equity or positive equity. Where are you at? So I'll give you an example. So I've been waiting for the interest rates to drop a little bit. Okay. And they have. Okay. The feds are supposed to be dropping more, but it's the secondary markets that are anticipating what's happening with the feds. So they're already getting them to come down because they want all the brokers to write these deals because when it drops, then they'll be able to sell them off again. So it's like a play on money. But to me, years ago, I put all my money in real estate, and whether I'm the lender or an owner, doesn't matter. It's in real estate, and it's been safe and secure. And I've never lost anything by doing that. Now, there's other avenues to capitalize even higher on that, and I think some of that was she mentioned something about you talked about infinite banking.
Yeah.
Okay. So there's two kinds of infinite banking that I know of. Now, I've got 5 policies myself, so I'm involved in it. Okay. So now I'm going to get some of this wrong, but there's one of those funds that's tied to the stock market. Okay. I can't think of the name of it. You don't want that one
Right.
because it's volatile. Okay. The other one is secure. And it's more steady. Then yeah, you could have on the other one you can go high, but you can drop low. But if you drop low, now you're not making anything, that kind of stuff. So the one I'm in, we're a consistent 4 to 5% no matter what. Okay, now it's compound interest. Do you know the difference between compound and simple interest?
A little bit.
Okay, so compound interest, let's just say you take $1. And if you pay simple interest, so I pay you simple interest.
Right.
Okay, so whatever dollars you have with me, I pay you an interest rate on that. Compound interest means that you take that money that I would pay you and you put it right back at me, and I keep paying you a higher interest because you keep giving me more and more money. It keeps compounding on itself.
Okay.
So compound interest needs time. It's not get rich quick. It's let that time run out. So you need 10, 20, 30 years. And if you run that formula on compound interest, you can put $100,000 away and say 10%,
Yeah.
never touch it, and in 20 years it could be worth possibly $1 million because of the compounding. Simple interest won't get you there, okay? But compound interest is very hard to get a hold of. So that's where the infinite banking does come in because it's compound interest, okay? When you're investing in a life insurance policy, okay, is what you're doing with the infinite banking. With life insurance, an agent's going to try to sell you the max benefit of that policy with very little cash value, okay? Because so if you die tomorrow, you're going to get, let's say, $1 million policy, you'll get the $1 million. But if you want to cash out, there's no money to cash out. In infinite banking, you're buying for the cash value, not the death benefit. So let's say you invest $100,000. Okay, on the $1 million policy, you get $1 million worth of life insurance. If you do it just the reverse, you put the $100,000 in. You're wanting to buy cash value. So you're getting very little on your life insurance policy. It might only be worth $100,000 in the next year if you die. What happens is as that cash value grows, now your policy goes up, and there's a break-even point where now it becomes that $1 million policy. But that's not why you're buying into this. You're buying in to give it $100,000 in. You're getting a compound interest. Let's just say it's 5%. So you maintain that 5% no matter what. Okay, with dividends, sometimes it's 6 or 7%. Okay, if you're in the right insurance companies for hundreds of years, they paid their 2% dividends year after year after year after year. Okay, but they never quote that to you because that's just a benefit. Okay, but they'll quote that 5% anyway because that's what you always earn. So the idea behind infinite banking is you invest that $100,000. And within 30 days, you're able to pull back about $90,000 of it. So you can take that money back out. You're not borrowing your money. You're borrowing the insurance company's money. Your $100,000 stays there and is making that compound interest of 5%. Okay? So it's sitting there working. You're borrowing from insurance company. You reinvest that $100,000 or $90,000 into, say, us. I pay you back 10%. The whole idea is you got to be religious on it, in that you paid back your insurance policy that until you get to that $100,000 plus your interest. So now you're not only making 5%, you're making the 10% I'm paying you, but I'm paying you simple. They're paying you compound, but you have to borrow the money. So now you're going to pay a 4% interest rate on that money, but it's at simple interest rates, not compound interest rates.
Okay.
So if you really use the numbers, what happens is a 5% compound simple interest, you could even be paying back 6 or 7% on simple interest, and you're still making money on compound. It's weird as shit if you really do the graphs.
Right.
Okay?
No, I get it.
And I'm not the person to show you. I can line you up with the guy to show you all that.
Yeah.
The guy I bought my policy from.
Okay.
But he could show you all that, how that works. But the whole idea is you take that 90 out, you reinvest it, you get it paid back, you pull it back out again, you reinvest it, you get it paid back in, and you keep doing that. Well, as you keep adding to your policy, then you have more money to take out. So you keep taking that money out and you keep revolving it out. Or, for example, let's say you're going to go buy a new car. Instead of going out to the bank and you pay the bank 4 or 5% interest or whatever it is today, why not take the money out of your infinite banking? You go buy the car, and whatever the going rate is, say it's 6% on a car, you pay yourself back that 6%. You're becoming your own bank, is what it all is all about. Okay? So that's another way to think about it. You use it internally, or you use it externally and reinvest it into something that's going to make you money. But instead of paying the bank, you pay yourself, and you're making interest there. So at the same time, you're still getting that compound interest. So you may take $40,000 out for a new car, but you're still getting paid that 5% because you're not borrowing your money. You're borrowing the insurance company's money. That's how the infinite banking works.
Okay.
And there's different levels of how they set it up. So you got to be real careful of that.
Okay.
They can set it up where you want the big cash value up front so you can pull it back out and access it. Okay. There's two other levels. I found out a chiropractor buddy of mine is working with the same firm, but had a different representative than I did. He went in the middle tier, and he invested $100 for his wife and $100 for him, but he's only able to pull out $50 for each of them. And he says, why? I want to be able to pull out that $90.95. And I started researching it, and I called my buddy, and he says, well, they stuck him in this deal, but it's a different in the game, is what it is. And they didn't tell him that. So because I want to be able to pull my money out and reuse it right away. So my wife has one of the 5 policies we have. So she pulled it out and used it in her company. Instead of going out and borrow money somewhere else, she borrowed from herself.
Right.
And her company's paying it back into her life insurance.
Okay.
So it just makes sense for her to do that instead of paying the bank on something.
Okay.
And she bought a piece of equipment or something is what it was.
Makes sense. And that way, like, so say, because I'm a real estate agent, so say get, HVAC or whatever, I can just put it into the infinite banking?
Yes and no.
Okay.
So typically what happens is and I really need to get you set up and talk to my guy about it because he can explain more. Because what you do is you preload it, and you're only able to preload it X amount. Okay, so let's say you want to set up for 100,000, you can pay that 100,000 over the 12 months. You can pay $833 a month into it, or you can preload it with 100,000 if you have it sitting there. Right. So now that money's working faster. Okay. Other than you're just paying it out until it gets in there, you're not using it. Well, at the same time, if you're setting up a $100,000 policy, there's a certain number, I don't know what that is, that you can pay in up front so that money can start working faster for you. But you can only do it, my understanding is one time. So let's say you have a $100,000 policy, you might do payments on it, the $833 a month, but you're able to preload it with $50,000 plus the 100. So at the end of the year, you'll have $150,000 in your account. Okay. That stuff you got to talk to him about because it gets really complicated, and he can show you graphs and so forth. So you can pay in monthly, quarterly, twice a year, or once a year into the policy. So really, no. If you get a big check, yes, you can, but you can't overfund it, or it gets you out of the tax bracket. Okay. So all that money that's earned in here, and that's everything that's cool about this, it's all tax free.
Right.
All tax free. But if you overfund it, and I can't remember what it's called, MIR or something. If you overfund it, now Uncle Sam can tax you on it, and that's where your people help you. Yeah. But you can change your pay structure too. So let's say you are in the process of paying monthly on your 100,000, and all of a sudden you get a big real estate check, and it's like, oh, okay, I'm going to change my pay structure. I'm only going to pay twice a year, and my twice a year's coming up, and here's my check. And now I just paid my whole insurance for the entire year.
Okay.
Okay, so you can do stuff like that.
Okay.